Okay, so it is Wednesday, and it is exactly 10:21. Not exactly, but we got about 9 minutes until those oil numbers come out. We're looking at, again, the October contract. We have oil trading 67.28, and to back it up, I mean, quite a trend, man. You go back to yesterday early in the morning,
Yep.
you're trading at 65.40 early. You're up almost $2 solid from that level, trading 67.30. So what we're going to look at here is possibly setting up a volatility trade with exposure to the upside and the downside ahead of those EIA inventory numbers coming out at 10:30. So we got the underlying contract trading, let's call it 67.30. And jumping to, first we'll start off with the 11 a.m. expiration spreads. We're going to have a price point here of either 67 or 67.75, which we would get to use on our setup. And that's a little tough because you can see that if you're using the 67 spread, you're going to have 30 cents of intrinsic value to the positive side. That's just going to increase your cost basis. And if you wanted to try and use 67.75 to set up exposure both ways, you're going to have about 35 cents of intrinsic value to the negative. Now, those might be nice because one has a bullish bias, one has a bearish bias if you want that type of trade. If you're looking for a straight volatility trade, though, that doesn't quite line up too well because you have so much intrinsic value in one way or the other. So we jump to the noons. This is where you want to get familiar with what you're doing in here. Download the demo account because this lines up nicely.
Oh, that lines up good. Yeah.
67.25 is going to be the price point that we get to gain exposure to the upside. Here's our bullish spread. You'd be buying the spread. $1.50 exposure to the upside. What's nice is we'd have about 5 pennies of intrinsic value. We're 5 pennies above.
Much better than 20 cents.
Exactly. So buying that spread, 67.48, you're going to be paying the difference between 67.48 and 67.25. So you're paying $23 for the bullish spread. And on the flip side, the bearish spread is going to be about 5 to 7 pennies out of the money. So you're paying basically a similar premium minus the intrinsic value, right? So that's the difference of these two.
40 cents.
$40, which represents 40 cents in the underlying. So you would need 40 cents of movement away from 67.25 starts to become your break even. And it's not bad when you're trading at 67.32, so you got about a 7 penny start to the heads up. But pretty tight range in terms of getting in there with exposure to the upside, to the downside, defined risk of $40. And we get those numbers in 6 minutes.
It's particularly not bad because the thing that's intriguing here with this release is that you had a big drawdown on the API last night. The estimate seems to be a lot less than that. We just looked at the estimates, right? Well, at least the Bloomberg estimates, right?
Yeah. So I mean, let's pull it up. Even why not? So it's a cool. So this is a function on the Bloomberg that talks about the whisper number, right? So anybody can go in here and they can, if you have a Bloomberg terminal, you can kind of put in your estimate, and then they'll rank kind of what you do. So maybe you can gain some notoriety. You got a lot of fund managers in here. That you have an incentive to do well. And so they have the survey number, Bloomberg survey number, looking for a decline of 2 million barrels. But the whisper number is an increase of 1.2 million barrels. So they're not exactly sure.
And we had a drawdown last night of 6.5.
Yeah.
So you're talking.
That's where you saw the price giving that a little bit of a dip, where oil trading higher for the decrease. So those numbers come out at 10:30 every Wednesday. We got about 5 minutes to those numbers. And like we said, it's nice when oil sets up on that exact price point and just kind of finish the trade setup. Let's just see if any of these in the dailies.
Because 2:30, right?
Yeah, so this gives us exposure till noon. And what we'd be looking for on the 2:30s is potentially spreads with the exact same 67.25 price, right? So we'll go into the 2:30s first. We have 67. You can see a bullish spread from 67 to 70, a bearish spread. So that's about 30 cents of intrinsic value. Again, if you want to initiate a trade where you might be a little bullish, that's not a bad trade because you have the intrinsic value to the bullish side. And just jumping over on different things, but not a bad trade again. Let's just say you're bullish, man. Let's just say you think it's going to continue. You're able to buy at 67.46. You're basically paying 16 cents over where the market's trading at. And your losses are capped at 67, which is pretty cool when you have profit up to 70. So that wouldn't really work too well for a volatility trade. And pretty similarly, when you check out the dailies, your choices are either 66 or 68.50. So that's why we drill it down, and you get the noon trade trading at 67.32, and we get those numbers when we'll come back from that break. We'll see what happens.
We're going to get some good action out here today because between these oil numbers coming out right now, the Fed minutes at 2 o'clock, I think the market's definitely going to be looking at that, the statement inside those minutes, because what we still have is that we were at 60% yesterday for the second Fed fund future hike, and
Right there.
Yeah, it's still
Yep.
it's crawling up. It was 59 Monday, 60 yesterday, 61.8 today. Yeah.
Yes, totally.
Yeah. Stay right there, folks. Tommy and I are going to be coming back with those oil numbers. Welcome back, folks. So, crude oil inventories fell 5.84 million barrels. That was close to last night. What was it, 5.1?
5.2, I think, the API saw last night, but that was not quite the expectation for crude. But either way, the market, you're right, shaking it off in terms of a little bit of volatility, nothing too dramatic so far. We were coming into this number at about 67.30, setting up that trade, so we're a little bit under 67.07 as we speak and trading a bit lower.
Gasoline inventories rose 1.2 million barrels. That's a big number. I mean, you know.
Yeah, especially in light of maybe what they were looking for, pretty much in line with the API, but big numbers, you know. And there's the full breakdown.
Full one. All right.
Yeah, so you have the median estimate being a decline of about 2 million barrels, missed by almost 4 million barrels to the downside. Gasoline, they were looking for a decline of 1 million barrels, ended up being an increase of 1.2 million barrels. Distillates, more than they expected in there as well, a rise of 1.8 versus 1.3. Refinery utilization, slightly above. They were looking for a decrease of 0.5 point. And yeah, across the board. Let's just jump back.
And more than likely, what you see here, folks, so is that what are they going to do with all the crude? That's what's going on here, because you get the build in gasoline, you get the build in distillates, you got the crude, the refineries running at almost 100%.
Yes.
So it's like, okay, that's why this market's pulling back a little. It's just like, okay, what are you going? Big deal. So you have the barrels of oil, but guess what? If the refineries are running full, and they can't sell, they have a build.
And check out the gas chart. So we're not looking at gas, but gasoline investors are selling on this unexpected build in the gas market. So gas kind of tanking a bit, and to check back one more time in the oil market, kind of hanging. And again, the trade we're looking at is a potential volatility trade. It was going to have 67.25 being the point that you had to keep in your memory.
And we had to get, what, 45
$40 to $43, I believe was going. You have until noon. And so right now, you know, even with this move, you'd have about $25. And this is where it gets interesting. It's not an all or none game. You know, if this wasn't quite what you were looking for, boom, you can just take the money off the table, right? You take your 25 back, maybe lose $18 on that trade, both legs of it. And the thing to consider is you take that off on the downside right now, right? Here's your bearish spread, 67.25 down to 65.75. Yeah. You could buy that back right here, okay? They're going to give you $32 for that. Right. And this bullish one still remains active.
Well, that gets interesting too, because we were into it for 43, right?
Exactly.
And you got 32 back, so you're really down to 10.
You cut your cost down to $10, $11, and if you're really looking for more upward exposure, this spread remains active until the noon expiration.
That would have to go to 67.35
to become your break even, right? Because then you got about $10 in there. But we'll see. We're under $67 now, 66.97, and we'll check back through the hour, see how that reacts.
Welcome back, folks. Dow down 9, NASDAQ up 20, S&P's up 3.5. Oil right now, we have had some action here.
Yeah, one final check-in through the hour, so about 10:55 now. When we were looking at it last, we were right at 67, right? We're saying you could take off kind of the value you had to the negative side, and if you got an exposure to the upside, and man, quite a bar that followed that conversation. So you go from under 67 to almost 67.60, and this would be your bullish spread now, that you could sell that, and you'd be getting $26. You needed about 10 or 11 to break even, so that puts some positive spin on the trade, but volatility nonetheless, man. We'll see what happens.